Traders at UBA said the move by Nigeria's Debt Management Office to issue 219 billion naira less than the 409.9 billion naira that was on offer reflects a reduced borrowing appetite. Although market sentiments remain positive as investors scrambled for higher yields. Kenneth Onuoha, team member, Assets and Liabilities Management at UBA, joins me for a market updates and review for the week. Kenneth, thank you for joining us today.
Thank you for having me, Esther. Right. Good afternoon.
Afternoon. Let's start with this DMO offer, 409.9 billion. That was to be offered, but DMO sold 219 billion. Help us understand why this was the case.
Okay, so like you did point out, there was an NTB auction on Wednesday where 409.9 billion was supposed to be up on offer. Interestingly, we saw the subscription level hit about 1.09 trillion. Now, when the results did come out, we saw just only about 291 billion being put up on offer. Clearly, it's indicative of the current borrowing appetite of the federal government, especially as it concerns the domestic market. You would remember that sometime on Monday we did float the domesticated dollar bonds. And then, of course, that's where the interest of the government is currently right now. But in the fixed income space, we can confirm that just about 291 billion was actually eventually allotted as against the 409.9 billion that was actually put up on offer. Stop rates we saw did print at about 18.2, 19.2, and 20.9, which was, of course, a reduction across all the three standard tenors, which is, again, the first time it's happened in a very long period. And that is indicative of where the DMO is leaning towards, basically.
Well, is it too early to say that this could potentially be the trend going forward?
Oh, well, it is okay. It won't be out of place for you to say that, especially when you look at the fact that when the inflation figures did come out sometime on the 15th, sometime last week, we saw that the inflation numbers did print lower this time for the first time in 19 months from 34.19 to 33.4. So clearly it's indicative of the fact that this is where we hope that the trend would follow in the coming days.
And what do you see in terms of that interplay between, obviously, investors always wanting a higher yield, but the government, the federal government through the DMO, always trying to balance that, I mean, as low yields as the government can get, obviously because of the implications for debt service. How do you see this playing out going forward?
Oh, well, so again, it's a function of the need of the government. So long as the government do not have that need, of course, they would like to see how they can price this instruments to yields that are favorable for them, especially when you consider the fact that the debt burden on the government is significantly increasing with the high rates that we were turning out at the beginning of the year up until recently. So we do expect that the interplay will continue. The investors would still want to see increasing yields, but so long as the government has met its demands in terms of, or it's met his needs from the domestic market, we will continually expect that the government will want to force down the rates.
Right. Talk to us about market liquidity trends this week. I mean, I think now that we're at the end of the week, liquidity still looks pretty good.
Funding pressure did ease this week. I mean, the week started with system liquidity at about repo balance of over 108 billion. As we speak today, just a few minutes ago, the system liquidity is currently over 1.2 trillion, up from the 743 billion that we saw as at yesterday. What all of this is as a result of the inflows that we did receive. We saw FAC inflows that come in this course of this week. We saw bond coupon maturities, bond coupon payments rather, where we saw payments of about 252 billion at the beginning of the week, and we saw about 112 billion that is supposed to hit the system today. Now, all of that with the NTB maturity of over 283 billion did, of course, cause the increase in system liquidity to the levels we currently see them at. Interestingly, this, of course, has had significant impact on the funding cost, where rates overnight and OBB rates are now currently trading at about 26.05 and 25.63% respectively. Just before I stepped up, the CBN we saw CR activities hit the system. We saw debits hit an unspecified number of banks, the impact of which we will see by Monday.
Right. Let's talk about the Naira dollar movement this week. Naira still hovering at above 1,500. Talk to us about what you've seen this week. And of course, obviously few weeks ago, the RDAS that the CBN conducted, I mean, we know that dollars continue to come from different sources, and all part of the CBN's reforms to increase as much as possible liquidity in the market. But talk to us about the range that we've seen the Naira this week, and if that could potentially change in the coming week.
All right, so yeah, the Naira to the dollar, we saw the value of Naira to the dollar drop by 274 basis points to close at 1586.11 as at close of business yesterday. Now, when we put that side by side with what we saw at the beginning of the week on Monday, where the dollar was about 1,579 levels, of course, it portends cause for concern. However, the good part was when we saw, sometime on Wednesday, we saw the Naira strengthen against the greenback to close at 1,543. This is on the back of increased activity in the NAFEM window, where the turnover did increase significantly to over $170 million. Now, only yesterday, of course, we saw it at 1,586, and coincidentally, the market turnover did drop to 120 rather. Now, this is, again, range of beats we saw was about between 1,500 and 1,603. Right. Clearly, is it indicative of where we see the market in the coming days? We do expect that these rates would obviously go down, especially when with the interest we've seen in the domestic bond. We expect that, yes, the impact of this will be seen in the coming days. All
right, Kenneth, we'll leave it there. Thank you so much for bringing us up to speed. Kenneth Onuoha, team member, Assets and Liabilities Management.